Welcome to the Achievable FINRA podcast. I'm Tyler, the founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, Series 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time. A full textbook, videos on key topics, thousands of questions backed by our memory-enhancing algorithm, and full-length practice exams. You can try it out for free at achievable.me. And if you like it, use the code podcast to get you 10% off at checkout. This podcast was made from a video by Achievable's FINRA course author, Brandon Rith. If you'd like to have the visual aid of a video, please go to Achievable's YouTube channel and search for the video by the same name.
Reverse stock splits are a way for a company to legally manipulate its price upwards without actually breaking the law. Now, why would a company actually want to do this? Most of the time, it's because they believe their stock price is just too cheap. In 2011, just a few years removed from the Great Recession of 2008, Citigroup was trading around $4 per share. Now, that's a really cheap stock price, especially for a large, well-known bank like Citigroup, especially knowing that most company stocks trade somewhere between $30 and $100 per share. When investors look at a stock price that low, it usually has an effect on whether or not you think the company is successful. And whether it's true or not, it's a reality of investing. Therefore, Citigroup went through a process of increasing their stock price through a 1-for-10 reverse stock split. Let's go through the math to understand this a little bit better. Assume we have an investor that owns 1,000 shares of Citigroup stock at $4 per share prior to the reverse stock split. The easiest way to calculate the change to the customer's position is to find what I call the stock split factor. Let's go back to the stock split numbers and we'll divide the first number by the second number. 1 divided by 10 will give us 0.1. We'll then use that factor and multiply it times the number of shares and divide it by the price per share. This customer will end up with 100 shares of Citigroup stock at $40 per share after the reverse stock split. The overall value the customer started with should be the same overall value that they ended with, and this is a great way to check your math to make sure you did the right calculation. This customer started with $4,000 of Citigroup stock, and they ended with $4,000 worth of Citigroup stock. And any stock split calculation question, if you don't end up with the same overall value that you started with, then your calculation was done incorrectly. Stock splits technically affect the par value of common stock, which is typically an irrelevant piece of accounting information that means nothing, but anything that changes par value of common stock requires shareholder approval. So, this is something a company can't just decide to do. If they want to pursue a stock split, whether it's forward or reverse, they'll need to send a vote to their shareholders and gain a majority of their approval to do so.